Today, we got some interesting news from NVIDIA that just threw flashbacks of the whole 2008 mortgage-backed securities debacle. Apparently, folks are trying to financialize GPU debt. To understand what this means, you need to go back a bit. In the 1970s, Wall Street figured out how to take home loans, bundle them all together, and sell that exposure off to investors throughout the world as mortgage-backed securities. And for a while, this concept worked incredibly well until 2007, 2008 happened. Now, the reason I made this connection is not because I'm a genius, but because I was watching CNBC. And BlackRock CEO Larry Fink said it live there first on CNBC.
I look at the financing of data centers. This is the very beginning, like what it was when I started in the mortgage-backed securities market in the 1970s. And I look upon this as a next future for financial engineering.
Larry Fink basically compared what NVIDIA is trying to do today in building the AI infrastructure financing to the creation of the mortgage-backed securities in the 1970s. So what exactly is he talking about here? NVIDIA just released an announcement to partner with BlackRock, Blackstone, Apollo, Brookfield, Goldman Sachs, and KKR, all the heavy hitters, to establish a financing platform designed to mobilize more than $500 billion of third-party capital for AI infrastructure build-out. And the really interesting part isn't necessarily how much money. Instead, it's what Wall Street is being asked to do with this money, what it's being asked to finance. It's being asked to finance AI compute and physical infrastructure to support that AI compute. So that includes obviously the GPUs, the data centers itself, all the power leading up to the data center, the revenue those assets generate, and other items related to overall AI compute. NVIDIA is no longer just selling the picks and shovels of the AI boom anymore. Instead, it's now moving to help Wall Street build the financial system that pays for the picks and shovels that, of course, NVIDIA ends up selling. This obviously has the potential to kick the AI trade to the next level, but it also increases risk to the economy and makes AI even more systematically important to the economy than it already is. If you saw in previous videos, I mentioned how CapEx related to AI now accounts for roughly 70 to 80% of all GDP growth, right? So it's already a big part of the economy. But before we go on, welcome back everyone to the Lunch Money Investing channel, where an ex-math econ nerd, that's me, breaks down market-moving topics so that you can make more informed decisions to grow and protect your lunch money over time, of course. If this type of content sounds interesting to you, be sure to smash that like button and subscribe. I post content like this weekly. Anyways, let's go on to the main story here, okay? Let's get started by breaking down how this all worked or how this all will work. Again, it's still early. We've only signed MOU, so nothing is set in stone quite yet. So we're going based off the latest announcements from NVIDIA, okay? So for years, we've thought about GPUs like any other piece of technology. You buy them, they depreciate, and eventually something better comes along, just like everyone's favorite iPhones, right? Jensen Huang wants Wall Street to think differently about that. He wants to reshape the conversation and shift it. Instead, NVIDIA is now describing AI compute as a productive asset itself, something that can generate revenue over a long period of time. And that reframe or that change in narrative, that matters because real estate gets financed, toll roads get financed, power plants can get financed, but a temporary technology expense, that's a much harder idea to finance at an enormous scale. So if NVIDIA can convince investors, if it can convince Wall Street that AI infrastructure isn't simply a pile of expensive technology, but instead it's an asset capable of producing predictable cash flows over time, suddenly there's a much larger pool of institutional capital available to fund all of this. And that's essentially the idea behind this new financing push from NVIDIA. Instead of an AI company simply paying for a massive data center entirely from its own balance sheet or from its own cash flows, financial institutions can now evaluate that proposed infrastructure, that proposed project, the power that's going to go to it, the customers that are scheduled to use it, and the revenue that that compute is expected to generate. The hardware itself can also have collateral value itself. Obviously, right, these GPUs are not cheap, so they're actually worth something themselves. And NVIDIA has said it may provide up to 25% in residual value support in certain financing structures, helping reduce the risk that the equipment that they're selling is worth less than expected. But here's an important distinction here. NVIDIA itself is not guaranteeing the $500 billion worth of proposed debt. These are, of course, preliminary financing platforms, as I mentioned already, and the actual structures of these notes are still under development, but the lenders themselves are expected to conduct their own due diligence and do their own underwriting. So the pitch is not, NVIDIA will pay you back if this fails. Instead, the pitch is, this infrastructure itself can generate enough economic value to support the financing that's being proposed. And if that's true, if that idea can actually be realized, it opens up massive new sources of capital for AI build-out. Think about an AI company that wants to build a multi-billion-dollar data center. It could spend billions of its own cash to build this thing out. Or instead, it can borrow against the infrastructure and the expected cash flows. If institutional investors believe the data center can generate reliable revenue, they don't necessarily need to care whether the company building this stuff has billions of dollars sitting in the bank. Instead, they care whether the asset produces enough cash to service the debt, just like a rental property. That's a fundamental shift. Compute becomes cash flow. And that brings us back to Larry Fink's mortgage-backed security analogy, or more broadly, just the mortgage analogy. The point isn't that NVIDIA is literally creating mortgage-backed securities out of GPUs, because that's not exactly what's happening. That's just the analogy that I'm proposing, or that Larry Fink is proposing. The point is that Wall Street has historically always found a way to transform individual physical assets and their cash flows into financeable investments. And the AI infrastructure can become the next major example of this. A data center stops being just a technology project. It becomes an infrastructure investment. And if that happens at scale, the amount of capital available to the AI industry could drastically increase overnight. Now, there's a reason sophisticated investors might actually be comfortable with this, despite the obvious threat of depreciation as new hardware comes out. After all, NVIDIA is constantly iterating and inventing new chips. And the idea that helps balance out the depreciation risk is called CUDA. And that's basically NVIDIA's software ecosystem that potentially gives its hardware something that's extremely valuable to lenders: fungibility. If an AI startup gets a whole bunch of GPUs or finances a whole bunch of GPUs and then defaults, those GPUs don't necessarily become worthless. Instead, another company can potentially take that same hardware that they just financed and defaulted on, and they can use that on their own workloads. That creates the potential for a secondary market for the equipment. And that makes financing the hardware look a lot more like financing a productive real estate property or a rental asset. The thesis is then basically this: the GPU generates compute, the compute generates revenue, and the revenue itself is what services the debt. And because the hardware remains useful to other customers, other players, the lender has collateral if something goes wrong with the borrower. And that's a pretty compelling argument. And it's one reason why NVIDIA believes AI compute can become an investable asset class, just like rental properties. But there's a problem to all of this, and it's a pretty big one. CUDA can slow depreciation, but it can't stop it. It can't stop obsolescence from technological process. A GPU can become obsolete overnight when a new architecture arrives. We just saw this when NVIDIA upgraded from Hopper to Blackwell architecture, and NVIDIA is already moving towards something newer and better, the Vera Rubin architecture. Every new generation raises the same question: what is the old hardware actually worth now that there's something better and newer? Because the physical GPU might still work perfectly fine, but that's not the same as being economically competitive. If a newer chip can produce dramatically more compute per dollar or per watt of energy, the older chip can become a liability, even if CUDA's software ecosystem continues supporting it. If the cost of that hardware gets too high relative to what customers are willing to pay for the compute, eventually you have stranded capacity. And that's where the comparison to real estate starts to break down. A building doesn't become obsolete simply because someone built a better building down the street. But in technology, newer is usually better, and newer technology usually renders older technology obsolete. Not always, but usually. And this is where the story stops being about just NVIDIA's financing strategy, or rather the strategy of financing NVIDIA is proposing. If we follow the money, we can start to see other risks emerge from this proposal. Well, let's start with the base case, right? The good case, where a lender provides capital to an AI infrastructure company. That company uses the money to build a data center and buy, of course, NVIDIA hardware. NVIDIA gets paid, they get their money right out the gate. The data center then has to generate enough revenue from that compute that they just bought to repay the financing that they just took on. If AI demand keeps exploding, this works beautifully. More demand creates more revenue, and more revenue supports more financing. And more financing, of course, creates more infrastructure, and that infrastructure, at the end of the day, requires even more NVIDIA GPUs. It's a really beautiful cycle, especially if you're NVIDIA. But what happens if AI demand disappoints, even by a little bit? Say utilization falls, compute prices falls, cash flows weaken. The borrower who took on this debt now has trouble servicing the debt. And now the lender isn't just looking at a struggling AI company, it's looking at collateral that also itself may be losing value. And that's an important distinction. The risk isn't just the GPU unit itself, it's now the debt that's attached to that GPU. And who ultimately holds that risk? Who holds that debt? That's the question we really have to ask from this whole structure, from this whole proposed structure. Now, I want to be very clear about something. We don't exactly know how these specific financing structures will ultimately be packaged or who will be holding every last dollar of the resulting debt. This is still early in the conversations. These agreements are still preliminary. So I'm not saying that BlackRock or KKR are about to dump all these AI loans into pension funds and other endowments tomorrow. But historically, if we just look at history, large private credit markets don't necessarily end up with the original lender holding every loan forever. Eventually, the bag gets handed off to someone else. Credit, of course, can be syndicated, structured, refinanced, or distributed to other investors after it gets chopped up. And that's where the potential systemic risk comes into play for all of this. Because if AI infrastructure debt eventually becomes a major asset class, exposure doesn't have to stay with NVIDIA, the AI startups, or even the original lenders. That risk can spread throughout the financial system. And that's very different from simply owning NVIDIA stock. If NVIDIA stock falls tomorrow 50%, the people who own NVIDIA take that hit. They absorb that risk. But if an enormous amount of debt has been built around AI infrastructure and the underlying economics of that system deteriorate, the losses can potentially travel much further. They're no longer contained to just a handful of players. That's the potential systematic risk, and that's the lesson investors should take from the mortgage-backed securities analogy. Financial engineering by itself doesn't eliminate risk. It simply redistributes it to other players. This is why another piece of news from this week caught my attention. On August 10th, the SEC clarified that certain bonds used to finance data center infrastructure would not be treated as asset-backed securities under key securitization rules. Securitization, yeah. That could make another source of financing available to data center owners as they try to raise huge sums of capital required to build their AI infrastructure. Now, to be clear, this is not the SEC approving NVIDIA's $500 billion plan, but it doesn't hurt the plan either. So that was all the what happened. And here's my take on all of this, right? I'm not here to tell you that the AI boom is a fraud or that it's about to collapse tomorrow. I actually think the bull case is pretty compelling for all of this. AI infrastructure genuinely requires enormous sums of capital. And if Wall Street figures out how to finance AI factories based on those future cash flows, that could unlock hundreds of billions of dollars, potentially much more over time. And all of that could be used for the next phase of the AI build-out. And NVIDIA sits directly in the middle of that ecosystem that it itself is trying to build. This means more capital for more infrastructure. More infrastructure, of course, demands more compute. And more compute means more NVIDIA GPU units get sold, as well as all the supporting parts, the high bandwidth memory from chip makers like Micron and SK Hynix. More of everything, basically. But I also think investors need to understand what happens when you put leverage on top of a rapidly evolving technology that can also depreciate. Because if the economics works, this financing model could accelerate the AI boom. If they don't, however, that same financial system being discussed today, that can amplify the boom and it can amplify the bust. That's why I don't think NVIDIA just created the next mortgage-backed security, but I do think it's helping create something potentially just as important, a financial market for AI infrastructure. NVIDIA is no longer happy just selling the picks and shovels anymore. It's also helping Wall Street finance the gold rush itself. This creates opportunities, but also obviously the risk of circular financing. We don't get away from that, right? This actually kind of reinforces that. But that's the question I'll be watching going forward. And if you want to understand how this financialization of AI develops and what it could mean for investors and your lunch money, make sure you're subscribed, because I think this is just the beginning of a much bigger story. Anyways, that's all for today. Until next time, protect that lunch money.